What is the Fed holding interest rate means for the AI boom? To answer that question, first let's look at why the Federal Reserve didn't lower their interest rate or raise them. Here's the part most people missed. There was a 9-3 vote, and the three who disagreed didn't want to cut the rates. They wanted to raise them. Because inflation is still above the target threshold, which is 2%, and that's because of the energy prices, the conflict in the Middle East, and the supply shocks. The job market is cracking, and the last report shows that we added only 57,000 jobs, which is less than half what it was expected. So Fed was stuck. If they cut the rates too early, the inflation gets worse. If they raise the rates, then a slowing economy breaks down. So they waited. But here's why AI investors should care. AI isn't only built with softwares, it's built with billions of dollars in capital that's deployed towards data centers, electricity, chips, and semiconductors. And those are financed over decades, and they are priced based on the long-term bond market, not the Fed rate. The day Fed held the interest rate, the 30-year Treasury yield hit 5.2%, and that's highest since 2007. The Fed didn't move, but the cost of long-term financing went up anyway. Here's the part a lot of people aren't talking about. The Fed itself is arguing in the favor of AI build-out, and the chairman is saying the build-out will lower the inflation. But some of his committee members think it will increase the inflation, and that might be one of the reasons why the Fed can't cut the rates. Here's a signal. As a smart investor, don't just look at the rate cuts. Also watch the 30-year Treasury, because that decides which AI projects get built out.